Will record low unemployment push up interest rates again? We know that interest rates haven't slowed down jobs growth, jobs creation, or raised the unemployment rate like the Reserve Bank wanted. And in this week's Property Insider video, Dr. Andrew Wilson and I give some of the reasons why this is occurring, and Dr. Wilson gives some thoughts about what's happening in the future. We also talk about a very interesting statistic about housing commencements. We discuss the auction clearance rates, and he gives a hint at what's going to happen in the results that are going to come out shortly for the end of July, what's happening to property prices around Australia. If you want to keep up to date with what's happening in our property markets, please subscribe to this YouTube channel and click the little bell icon so we keep you up to date each time a new show comes out. The interest rate increases we've all had to endure over the last year haven't really had the impact on certain segments of the economy that the Reserve Bank had hoped. For example, the unemployment rate remained at 3.5% in June, while the Reserve Bank's actually been trying to slow down our economy by slowing jobs growth and raising the unemployment rate, the opposite of what's happening. So does this increase the chance of another rate rise when the Reserve Bank meets next week? That's one of the questions I'm planning to ask Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Markets. I'd also like to discuss what's happening with home building commencements and see if we're getting anywhere in alleviating the severe housing market shortage we're experiencing around Australia. And as always, we'll have a chat about what's happening in our auction markets. Hello, Andrew.
Yes, good day, Michael. And we had some very interesting data out last week. Of course, the June unemployment numbers or June labour market figures, and they were absolutely astonishing again. And really, this does beg the question of just what the Reserve Bank have been doing with their interest rates. There's absolutely no sign of slowdown in this economy. If anything, Michael, it's getting stronger, can you believe? And this really does question the direction of interest rate policy, the pause 1 month, the rise the next month, the pause the next month. The Reserve Bank keeps telling us that they're following the data, that they're going to rely on the data as it comes through in making their interest rate decisions. But the data has been strong, and yet we've got this roller coaster response from the Reserve Bank. Let's hope that the new governor perhaps can add a little bit more credibility to the bank's decision making in terms of following the data. But as I said, Michael, this it just really is perplexing, the difference in what the data tells us and what the Reserve Bank is doing with their interest rates. And I think putting rates on pause when we do still have very strong economic conditions is only really laying the foundations perhaps for further interest rates at a higher level, because those pauses can only add confidence to an already perhaps overstimulated economy.
Well, the Reserve Bank's got a few things to grapple with it hasn't had to do, I guess, in the past. If we look at what happened this cycle, we started with much lower interest rates than in previous cycles, really wartime interest rates. But inflation was higher than when central banks had to raise interest rates before. We started with a much lower jobless rate, and Australian households came into this interest rate cycle with unprecedented piles of cash. We stashed our cash during the pandemic. We couldn't do anything, we couldn't spend. And at the same time, the government gave an enormous amount of stimulus, supported us in all sorts of ways. So it's been a very different cycle, and the old rules didn't seem to work this time around, Andrew.
Well, they don't. And do they ever work the second time around or the third time around, Michael? You know, it's certainly a movable feast economic policy. We understand that, and that makes it very difficult for policymakers because they have to rely on some substance in terms of their prognostications for the economy. But they've clearly said, look, we're relying on the data. The data has been unequivocally strong, really, and yet they had this bouncing around, this flip-flopping in terms of interest rate policy. You know, let's get it over and done with. Let's create less demand and put downward pressure on inflation and get on with a more balanced economy. But we're far from that at the moment. And really, the only improvements we've seen in inflation really has been the sharp decline in the price of oil. And that would have happened regardless of what interest rates have done or of an increase in interest rates. We've seen the price of oil halve over the last 12 months, Michael. Of course, that's been a significant contributor to falling inflation, headline inflation in all advanced economies. But when we look at underlying inflation, particularly in Australia, it really is still substantially higher than the target range. You know, we're tracking at around about 6.5% underlying inflation. which takes out volatile items such as food and oil. And the target's 2 to 3%, Michael. We're miles away from that. Services prices are rising at their strongest rates in decades. And this, of course, reflects the bidding up of wages and employers having to cover those higher wages with higher prices and without the productivity gains that normally support them. And as I said, we really haven't made any progress in the last 12 months, Michael, despite 12 interest rate increases.
Well, it seems the jobs are coming in Sydney as well. This chart of yours suggests that the Sydney unemployment level is the lowest around Australia.
Well, we've had some very strong results, as we sort of alluded to, Michael, over June. The jobless rate is steady now. When it was released, the May result was 3.6%, but that's been revised down to 3.5%. And June has followed that result, another 3.5% unemployment rate, Michael. That is a record low, Michael, unemployment rate for the monthly surveys. Of course, we have to go back to the early 70s to find a similar result. But they were quarterly surveys, and as we discussed frequently, it was a completely different Australia back in the early 70s, Michael, with basically just one income households. We also saw jobs up again over June. Now, of course, we know that jobs surged over May, over 70,000 jobs created in May. We followed that up with another 33,000, Michael, created over June. Very strong increase in the number of jobs created over those 2 months. And the number of unemployed also fell. The May unemployment numbers fell by 18,000. They were down by another 11,000 over June, Michael. The participation rate eased slightly by just 0.1% down to 66.8%, which followed the 66.9% result in May, which was an all-time record again, Michael. That reflects the proportion of the population in work. And again, it shows that people are in the workforce at the highest level that we've ever recorded. Most capitals are reporting low unemployment rates, and most states are reporting low unemployment rates. And as you alluded to, certainly as we've said, rate increases have had no impact on the real economy as they were planned to do. And we can see the unemployment rate is just really flatlined now this year at that around that 3.5% unemployment, record low rate. And when we look at the levels, the local levels, we can see that these numbers are very low, particularly compared to a year ago. No surprise that the Sydney market is leading the charge in terms of the unemployment rate and the reflection on what is happening in the housing market. So again, very strong results for our labour market. We keep saying that if you're following the data, Reserve Bank, we can't figure it out because the data couldn't be stronger, hasn't been stronger, and there's been absolutely no change over the last 12 months. I don't know what the Reserve Bank say, referring to when they say, oh, we want to wait and see what the impact is of higher rates. Well, we've seen 2 months of unequivocally strong labour market activity. And really, isn't it rational, and the Reserve Bank keeps telling us, that we need to see a weakening in the labour market to get our first sense that we're putting downward pressure on underlying inflation. Absolutely no sign of that to this point of time, Michael.
Now, I know some people are going to be listening to this, watching us and saying, hey, you don't understand. My rent's gone up. My mortgage has gone up. I'm having trouble. And there's no doubt some people are. What you're talking about is the real economy. In other words, businesses, if businesses weren't doing well, if businesses weren't able to sell their services or products, they wouldn't be employing more people. I mean, in fact, that's what the Reserve Bank's trying to do, slow down demand, yes, slow down employment, slow down businesses, but that's not happening. But yes, I'm sure there are a lot of people who are personally suffering, and that's a real shame. The Reserve Bank's in between a rock and a hard place, as they say.
Well, yes, Michael, but they can only go on the aggregates. These models are what they rely on for their interest rate policy. It's not doing anybody any favours to be putting off the hard, taking the medicine. You have to take more down the track. There is no sign that monetary policy has influenced what's happening in terms of our problems with inflation. And certainly it's great to have a strong economy, Michael. Those that are doing it tough, and, I'm not ignoring that obviously personal circumstances can be significantly different from household to household for a variety of reasons. But this is an economy that is providing the strongest labour market in our history. And also we're seeing wages rising at the fastest rate in over a decade. So if times are tough for certain households and individuals, for which we sympathise, at least the circumstances are there for employment and for income. That's what we should always be focusing on, because we do remember what can happen to economies and society when we do have significant downturns, such as that early 90s recession. We should celebrate how strong our economy is now, but it's not going to last in terms of what's happening with inflation, and we need to get that under control. That is the bank's mantra. That is what they're there for, is to control inflation primarily. It's not controlled at the moment, regardless of what the headline data is telling us. The Reserve Bank, I think, compelled on this data to raise interest rates again over August. And I can't see any real justification for not doing that. We will have the inflation data coming out in the next few days, Michael. I guess we rely on that to validate what's occurring. But that inflation data is a little backward looking, as we know, and it should be the focus on the labour market is roaring along at the moment.
Well, clearly interest rates are affecting some people and not others. On the weekend, Pam and I went to the Chadstone shopping centre. We had to pick something up, and the queues outside all the luxury shops, they had not only security guards but concierges to slow down the number of people walking into those shops, spending up big. So yes, the rich are getting richer during these challenging times. Now, moving to the housing markets, Andrew, you regularly report building approvals, but we've also mentioned that building approvals don't necessarily mean houses and apartment buildings are coming out of the ground. We actually need commencements. What's happening there?
Well, we've got an interesting chart that we put together, Michael, that compares approvals with commencements. Now, typically, what our chart here shows the time series of approvals versus commencements. And what we've done, we've lagged at 1 quarter. So we've pushed the approvals dates 1 quarter down the track, because when we look at history, it tells us that basically it takes that quarter for an approval to become a commencement. When we look at the chart, we can see it's fairly consistent what we've seen in terms of approvals tracking commencements or commencements tracking approvals, with that 90-day lag between when the builder gets their approval and when they actually commence the job. And now these are houses. Of course, it is different for apartments. We can see that's fairly consistent over the longer journey. But we are starting to see a breakaway in this, Michael. And if we look at the latest series for over the last 12 months, we can see, and this is up to the March quarter, this data for commencements and approvals, we can see there that the approvals data is actually tracking higher now than the commencements data. There was a blip over the last month, but you can just see that trend is starting to fall away, Michael, which is, of course, a significant concern, because perhaps it's showing us that even though builders are getting approvals, developers are getting approvals for houses, they're not converting them into commencements at the same rate as we've seen historically. And we've discussed this, Michael, that perhaps with very high building costs at the moment, house building costs at the moment, we may see this difference between the level of commencements versus the level of approvals, because builders and developers may be finding it difficult to have their approvals commence because of concerns over profitability with high building costs. And we're just starting to see that slight sign of a breakaway, Michael. Early days. So we'll keep track of this data series going forward. But the big problem is for the housing market is we're already seeing a significant fall in building approvals anyway. So if we're seeing lower building approvals and now we're seeing lower building commencements as a proportion of those building approvals, it means we're going to see even fewer houses being built and being completed and offering accommodation in housing markets that are clearly undersupplied at the moment. And we just have to look at those rental markets to see signs of that. And there's nothing governments can do, particularly trying to control high rents, except make the problem worse if they're trying to squeeze landlords. So another sign here that we need some supply side initiatives to get more houses and apartments out of the ground, so we can provide more accommodation for what is clearly a significantly constrained housing market. But I just think that data is showing perhaps some interesting trends, Michael, which we said may occur.
Well, we're seeing that in houses clearly in your chart, but I'm sure if we looked at apartments, it would be even worse, because building apartments are not profitable. Last week, National Valuers Charter Keir Kramer suggested that new apartments would have to sell for 25% more than current market values just to make them viable. So, and that's one of the reasons developers are not taking the financial risk in starting new projects, Andrew.
And it becomes self-perpetuating, Michael, because financiers tend to be a lot more pessimistic in terms of the outlook, and therefore they look for a much higher or lower risk profile in terms of their lending for developments, So it means it's tougher to get a loan for your development because it is tougher to get these completions or these commencements, even if you get your approval. So as I said, we need some supply side initiatives here, not fiddling around at the edges by state governments trying to constrain, rent increases, thinking that'll cause, all that does is it rotating the chairs on the Titanic, and it's not going to solve any problem. We need to solve it on the ground, in the ground, out of the ground, and by building more homes.
Well, on the weekend, Daniel Andrews suggested that his government's going to be looking at initiatives to help the housing shortage and particularly the plight of tenants. And there was the hint of charging people more if they're going to be putting out their properties for rent on Airbnb, another tax that he's bringing into investors, and also maybe limiting how often one can increase rents to maybe once every 2 years rather than once a year at the moment. That's going to put off a whole lot of potential investors, isn't it?
Well, you can only squeeze a significant portion of the electorate so far, Michael, without there being certainly some consequences, in my opinion. The investor has been targeted for years now as being the cause of problems in our housing markets, but I think policymakers have got to be putting up their hands because they've been attacking the wrong end of the pineapple. We're now running out of rental properties and creating even less incentives to be an investor in an environment where governments, we need more investors, not fewer investors, or else you're going to have to explain why we've got people living in boxes.
Shouldn't be happening in the best country in the world at the best time in history. I just wanted to interrupt this week's Property Insider chat to remind you this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat with you to help you take advantage of the new property cycle. If you think about it, an opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and your options? Remember, we've got no properties for sale, but we offer strategic advice to give you direction, results and certainty. This is the right time to get all your ducks in a row and get set for the opportunities that are going to abound. But be careful. Property investment is a process. It's not an event. So you can't just go off and buy any property and hope to be successful. Formulating a plan and getting the right advice is more critical than ever now. So why not have a chat with the team at Metropole? Go to metropole.com.au. Now, every week we look at the auction markets, and it's quite a winter time. And a couple of months ago, you suggested the markets are going to slow down over the winter time. They have a little bit, but overall the results have been pretty steady.
Yeah, Michael, I've been a little bit surprised to some degree at how the winter market has stood up this year. It is interesting because we had probably a couple of weaker weekends at the end of June and beginning of July. But the markets have certainly bounced back following the end of school holidays. We're really, particularly in Sydney and Melbourne, Michael, we're seeing some rebound in auction clearance rates. The numbers of auctions have risen also since the end of school holidays. Of course, that's predictable. But again, we're still seeing a much steadier result and at a higher level in terms of our auction results over winter so far. And I think that is reflecting the revivalist nature of our housing markets. We know that at this time of the year, we typically have a significantly lower proportion of higher priced properties in the market. That's occurring now. So we have a higher proportion of lower priced properties, of course, and we also have higher levels of, I guess you could say, non-discretionary sales going on, those that are transferring or have got divorced, sadly, or where there are deaths, through the winter period. That tends to raise those types of properties to a higher proportion. So you tend to have downward pressure on prices growth as well. But even with those circumstances, those seasonal circumstances, Michael, we're certainly not seeing any shakeout in our auction markets, even in regard to the quieter winter market. So we had some steadier results on Saturday again. The markets still are favouring sellers generally, despite the sort of the notional impact of what is usually the quietest selling season of the year. Brisbane and Canberra bounced back strongly from the weak results of the previous weekend. And overall, I think it was a very encouraging result for sellers with our auction results for what was the midwinter market. Right in the middle of the winter, we had Sydney Again, a surge in auction numbers, nearly 600 auctions in Sydney, which actually, Michael, is now higher than where we were a year ago. So all those that have been breathlessly explaining higher prices as a result of lower stock levels, of course, they're wrong, and now have to revisit those particular predictions, desperate predictions, in my opinion, or desperate excuses, because numbers are rising again at a higher level than a year ago. And Sydney had quite a healthy clearance rate, 75.3%, Michael, higher than the weekend before, and what we would clearly say is a seller's market result. Melbourne also had higher auction numbers, down a little bit still on a year ago. Its clearance rate continues to track over 70%, Michael, and it was down. But let's remember that the previous weekend, we had the highest clearance rate in Melbourne for the year. And despite those, certainly no action in the inner suburban markets relative to the season. Brisbane, fewer reported numbers coming through, although higher auctions had a stronger clearance rate, over 80%, down on recent results, just under 80%, but still a strong result. And Canberra also bounced back with similar auction numbers at 76%. When we look at the auction clearance rates to date, taking account of all the activity on the weekend for July so far, still tracking above 70% in both Sydney and Melbourne. Also Brisbane, above 80% in Adelaide and above 70% in Canberra. So really, Michael, there's no sign of the slowdown in the winter selling season. And next week, of course, we will have the first off the press with the July house price report. And just a little bit of a teaser for that one. Those that are looking for lower prices will be again disappointed, because we're certainly continuing to track higher prices again over the July quarter, despite the impacts of the winter market. And we would expect to see perhaps a slight easing in growth rates, but we'll wait and see and discuss that one next week.
Normally, this Property Insider video comes out on Tuesdays, but we'll be there on Monday, the 31st of the month, and we'll be able to tell what's happening in the housing markets around Australia. So look forward to catching up with you then. But of course, there's going to be the CPI result in between then too. Yeah. So a few things to discuss when we catch up next week. Thanks, Andrew.
Absolutely. Thanks, Michael.